You had told me a few weeks ago that you were looking for a drop. Did you expect it to be this precipitous, this quick?
No. We thought the market would be under pressure through October. We thought it'd go to the low 2200s. But we thought you'd see this kind of a break sometime early next year. But quite apparently, the market's doing exactly what it always does, and that's fooling 99.9% of the people. And that's why it's happening now. I would say Wall Street uniformly was unprepared for this magnitude of a drop.
Well, people, Black Monday is trending. Yes, the crash of 1987, you're starting to see old newspapers coming from those days and analog charts that are matching up to the NDX 100 right before the massive drop. Are you scared yet? Well, people are after a big down week in the S&P 500, finishing down 2.39%. Yikes! You can just see here the heat map. Some of the big drops came from NVIDIA, a large mega cap name, almost 9%, and Tesla reported earnings down 16%. Looking at a year-to-date perspective, things are still doing rather well. So in today's Stock Market Brief Show, we're going to be mapping out key levels and talking about one of the most important assets to be paying attention to. There's a lot of narratives out there, so we need to pay attention to our key levels and important intermarket assets to make sure we have a good grasp on what can take place in this market next. So let's first start off looking at the performance for many different assets. This is the week-to-date column, month-to-date, and year-to-date. If you see here, the year-to-date performance for the SPY still remains elevated at 10%, and then the Qs is up as well at 33%. Now, the month-to-date, we've been seeing a lot of volatility, but, the S&P 500 is only down 1.5%, and the Qs are down only 1%. The IWM is down the whopping 5.83% so far for the month. If you take a look here at the 10-year yield, this, for the week-to-date perspective, was up 6.37%. And when you see a move in yields, one of the more important intermarket assets to be paying attention to, you can get a lot of red, which we've been getting on our screen, especially if you pair that with the dollar that goes up as well. The dollar remained flat on the week, or just slightly down about 0.5%, flat on the month, but it is up on the year as it stands. We're going to get into some of the intermarket assets now. I want to first start off looking at some relative strength lines, and this is really going to give you a good idea of how important it is to be paying attention to things such as commodities and bonds, and what it means when they perform against each other, or which one performs better, what it means for the overall markets in various sectors. So I posted this May 14th, 2022, and I'll give you an updated chart. This is not an updated chart, but I'm showing you what I was saying here. So it's basically showing commodities versus bonds up here, and I said when bonds begin to outperform commodities, defensive sectors such as XLU, start to outperform the SPY on a relative basis. So that means when this goes up, typically you'll see the utilities go down, whereas if this goes down, this line will go up, okay? Now, right now, at the time that I posted this, utilities was outperforming SPY, okay? Utilities was outperforming SPY at this time. Right here, it was going up. The same time that commodities, the bonds, were outperforming bonds. And this doesn't happen often. We were looking at a monthly chart, and you can see that there's a very strong correlation between these two lines. And the last time this correlation happened was back in 2008. The time before that, when we had that strong of a correlation, was leading into 2000. And, we posted this May 14th, where we saw the market drop a little bit. If I update you on the chart, you can see that we did have more market turbulence that came down, and the correlation regulated itself back to negative. And you can see as commodities are outperforming bonds, utilities are getting hit rather hard here. Okay, so if I show it zoomed in even more, this is one of the charts that I posted up on Twitter. This is commodities versus bonds up here, utilities versus the S&P 500. You can see that commodities are really outperforming bonds right now, and the proxy I'm using is CRB for the commodities and then USB for bonds. And as this has been going up, you can see utilities versus the S&P 500 have been going down. So when I look at this, I think, okay, well, if bonds start to outperform commodities, meaning commodities potentially come down, or bonds start to fire off like a rocket ship and commodities stay flat, just have to outperform on a relative basis, and this line comes down, this could open the door for some possibility for these assets to play out quite well. Bonds and utilities. And remember, utilities is a defensive sector and it is more rate sensitive given, i.e. the bonds and how they are interacting. And this doesn't always stay into a negative correlation. You can see there are times, like I just previously pointed out, that it does go into a correlated state, but for the most part, it does remain in a negative correlated environment. One of the biggest commodities in the CRB index is energy, oil, right? And if we look at this through multiple different time frames as far as a correlation goes to energy stocks, you can see 15-day, 30-day, 90-day, 120, and 180. Typically, oil has a positive correlation to energy stocks. Okay, so as commodities are outperforming bonds, meaning the CRB index, so that means typically oil's going up, which means energy stocks are performing quite well there too as well. And remember, if bonds are going down, that means yields are going up. And you can take a look here, this black line dating back about, I think this is a 10-year chart. The 10-year yield is TNX. The green is energy stocks. And you can see that there's a very strong correlation between all of these assets. Okay, and now you might be thinking, okay, well, this is confusing. Why is this important? Well, take a look. 10-year yield is up here at the top. You have a relative strength line for technology versus SPY. Technology, right? The largest market cap names are tech names, okay? Apple, Google, Microsoft, NVIDIA, so forth, okay? So that's XLK relative to SPY. And then down here is energy relative to SPY. So what you'll notice here is as the 10-year yield is moving down, technology typically outperforms SPY. Not all the time, but for the majority of the time, when you have yields coming off, going flat, you can have technology stocks outperforming. Then you saw this rise in the 10-year yield, and that put some pressure for a while there on tech relative to S&P 500. And in recent weeks, trading weeks, months, the 10-year yield is continuing to rise, and the relative performance is kind of just flatlined over here, where we haven't seen much growth. Now, beneath us is the relative performance line of energy stocks over at the SPY. And what you'll notice is as this goes down, this is going with it. And as this went up, this is going with it. Okay, so this kind of just goes to here why there's such a strong correlation. As 10-year yield moves, energy stocks follow. Okay, and when I show you why that might be important to understand is because when energy stocks show leadership, meaning that when this line goes up, energy relative to the S&P 500, and you look at the S&P 500 down here, you'll notice as this goes up, what happens to the S&P 500? It typically gets weaker, right? Energy stocks go up. We've been seeing the S&P 500 get weaker. You can go back to even 2008 where we saw the S&P 500 drop. Well, what performed really well? Well, energy relative to the S&P 500 performed well, okay? And if we take a look here at oil, from a monthly perspective, and you apply a 10-month rate of change, so a yearly rate of change, what's interesting here is when you get a rapid rate of change to the upside in the price of oil, that has actually led to all, dating back to the 1987 crash or even the oil embargo, recessions and crashes in the market. So 1987 crash, right? We saw a big rip price in the rate of change of oil. 1990, the dot-com, the financial crisis. And even right here, we saw a massive move in oil coming off from really severe lows, and that started the 2020 bear market. We saw recent trading sessions in recent months a spike up higher too as well, which has been putting pressure on the S&P 500. If you take a look at the 10-year yield by itself, we've been in this up channel. We're kind of coming to the upper end of that channel. And if you take a look at oil by itself right now, it could very well be flagging, right? We broke down from this area of resistance, and now we starting to catch a bid up, but it is coiling up, right? Price action expands, then it contracts. So it has to recover and break above for a more positive take. But if this starts breaking down, what does that mean? Well, if oil starts breaking down, that could give us insight that the 10-year yield may be kind of coming to an end of its move. But if the 10-year yield wants to continue to rise, well, that means that most likely oil can continue to rise, energy stocks can continue to rise. And if that's the case, it could continue to put pressure on utilities. It could continue to potentially put pressure on, obviously, bonds as well if the 10-year yield rises. If I take a look at the 10-year yield by itself on a larger time frame, quarterly time frame, we are coming into an area that there was prior resistance, right? Prior resistance and prior support from that. And that's right just above and around the 5% mark, as on a quarterly time frame, the RSI is getting overbought. TLT, which is bonds, right, have been getting crushed to the downside, and it's pulling into a prior area of once support and once prior resistance. So right around this 80, 81, kind of where we are, can very well lead to a potential bounce. Now, if we take a look at unadjusted chart of TLT, just take a look at how much damage has been done on this drop. You can go back to the beginning of TLT, and you can see we are at a closing low, I mean, really since 2004 was, one of the lowest closing lows right now ever on this unadjusted chart. All right, if we take a look here, I found this to be interesting. TLT on the weekly time frame, it had its worst performing week of the year, right? Down almost 5%. We're going to round up 5%, and you had some record volume here that we haven't seen. So this could very well be moving into a capitulatory state. It could potentially go further, right? We'll be on the watch out because these are the most important assets, bonds and yields, right? But the last time we saw a 5% drop was actually the October bottom, and that led to an 18% rally before eventually rolling itself over. So we're seeing a rapid rate of change on some big volume, could be capitulatory. So are we going to see a very similar situation where, we kind of puke out everything and then all of a sudden we start to bounce? Well, we'll take a look at a couple other interesting things taking place. The 10-year minus 2-year yield curve is actually only 14 basis points inverted. All right, this thing has been kind of moving itself up to uninverted state, which, it's not going to stay inverted forever. But I want to remind everybody that when this uninverts, right, as we see this move up higher, the yield curve, what's been happening to the S&P 500, it's been kind of falling down. And you could see this since the inversion. As we go deeper into inversion, we see the SPY run higher. As this drops, we see the SPY run higher. It drops, SPY goes higher, drops, SPY goes higher. But when this goes higher, we've been seeing the S&P 500 kind of take a back seat. And if I look at this on a larger time frame, you can see we're about 14 basis points inverted. And other times when we uninverted, okay, you can see up here at the S&P 500, this is where, things started to break. However, this also happened during the Fed rate hike cycle, and then they paused, and then they had to slam rates back down, right? They raised rates, they paused, and then they eventually something broke, so they slammed rates. So if we get uninverted, and we're currently, right, the bond market is doing, the job of the Fed right now. If we're not going to be raising anymore, if something breaks, watch for the Fed to potentially change course or change narrative or something to take place where that could potentially obviously happen if we see more volatility and potentially, who knows where we might go with rates at that point. Jerome Powell seems very hawkish, and rates are going to remain higher for longer. So we'll see. We just got to manage risk as we see fit. If I look at IWM on the weekly time frame, this was a chart I've been pointing out too, how when the yield curve uninverts, there's a couple things you can watch for, right? The price action, it coils up. Volatility contracts as well, and you can see that something happens, rates go back down to zero, and then that's typically the best time to look for small caps when money is cheap. You can see as rates started moving up, price started compressing, going sideways, volatility started contracting, we had the yield curve uninvert, and boom, we saw a spike in volatility. Fed stepped in, market went higher, now the rates are up high, volatility is contracting, yield curve's uninverted. So are we going to see this uninvert and eventually something break where we see a big spike in RVX, Russell volatility, and the Fed has to do something quick in order to change it and flood the market with cheap money again? Well, we'll be on the lookout for if that happens. If you haven't done so, make sure to subscribe to the channel, because if it does, we'll talk about it. Another important asset to be watching is the dollar. I'm pointing this out. I thought this was kind of interesting from a technical standpoint. 3 lower highs is never really bullish. And you saw the dollar right here, boom, 1, 2, 3. You saw 3 lower highs, and then we really broke down. That's the kind of where the dollar started really, losing its gusto. And the S&P 500, you can see that when this, lost itself, that was the move higher in the S&P 500. So the top of the dollar marked the bottom in the S&P 500. I just wanted to call out that the S&P 500 is doing something pretty similar. 1 high, 2 high, and 3 high, right? They're all lower highs. So if we're going to be breaking down, is the dollar compressing itself for a potential move higher, while this takes another back seat lower? Well, the way that you want to watch this is if we get back above 4,400 on a close, then we'll at least break above this prior high. So that can change the narrative to see a potential higher high. And then if we pull back to a higher low and higher high and higher low, which could change the current trend, which is obviously down. Another important asset obviously is gold, but you can look at copper relative to gold. And when this line goes down, there's a flight to safety, typically meaning that gold is outperforming copper and copper is actually breaking down. And, you can see that, during the pandemic that broke down, 2016 that broke down. I think it's a good gauge on the economy where, Dr. Copper is an economic metal and gold is more of a safe haven. If I take a look at copper from an absolute standpoint, you can see high, lower high, lower high, lower high. And then you see this compression. This looks like it can snap and break, so be very careful here because there is typically a tight correlation between copper and the S&P 500. And there are sometimes divergences you can watch out for. So for example, the bottom, right? So we saw higher highs. Meanwhile, the S&P 500 was putting in lower highs, and copper telling us, how is things shaping up here from an economic standpoint? Well, we started rallying, and that actually gave us insight that the S&P 500 could follow suit. The same goes for negative divergences. We saw S&P 500 rallying, but copper wasn't following that narrative, and now we're starting to see that weakness pull back in. If you look at gold from an absolute standpoint, this thing right here, everyone was saying it's no longer inflation hedge high. Everyone says it's doing good, but then it breaks down, and then a few trading days later, a few weeks later, bam, this thing fires off like a rocket ship. There's obviously a lot of geopolitical risk right now. There's a lot of volatility being packed in. We have earnings and all kinds of stuff on deck, which is we're going to transfer into what's on deck. So these are what's reporting earnings coming into this next week, which let me just tell you now, it is adding an incredible amount of volatility, and I'll prove it to you by showing you the expected moves. But we got Microsoft, we got Google, we got Amazon, so some of the bigger names there. However, if you look at this list, this is all the ones from the S&P 100 reporting earnings next week. That's 38 tickers, okay? In the S&P 100, that means 38% of the tickers in the S&P 100 are reporting. So next week is a huge earnings week, all right? And if you take a look at on the calendar for economic activity going on, we have Fed Powell back at it again, right? He was out just this last week. We get S&P Global Composite, some PMI flash numbers. We have durable goods, GDP growth rate. We have core PCE, personal income, personal spending out as well. So all this is adding to the bigger picture of how much volatility can very well be priced in, which I'll show you that momentarily here. S&P 500, let's hop into it. So we talked about the weekly chart already, but clearly that is why people are, talking about, 1987 crash, is because clearly there was a lot of volatility this last week. We were up all the way up here at about 4,400, and then we closed all the way at the lows. So talk about just a huge outside trading week, large authoritative candle closing at the lows going into Monday typically tells us that we can press a little bit further to the downside. So be aware of that. But being that it's such a huge candle, if we do gap up, it's likely to see an inside trading week as well. Okay, so if we start bouncing up, start looking at that 4290, potentially 4300, we'll mark out some expected moves. These could act as a potential area of resistance as we had a closing price, an opening price, and then an opening price right here these weeks. So there can be some resistance up in that area. Now, if we take a look at the weekly expected move from last week, we closed just outside of it. But remember, last week we talked about how much more volatility is expanded. So this was, a $90, plus or minus expected move. The one prior to that, the prior week was plus or minus, I think it was 74 or something like that. So we went from an expected range boom, boom of 74 to plus or minus 90. And everyone's like, yeah, whatever. And then all of a sudden we close down here. So, was this to be expected? Yes, the market did. It's acting efficient. It did what it was supposed to do, albeit we closed outside of it ever so slightly, including the daily expected move. But we came in, we tagged it, we bounced up from it, and we traded basically around there up until the end of the day, right at those levels. If we take a look at the weekly time frame or the weekly expected moves for SPX and the SPY, we have the weekly expected move now at 94. So with earnings, with the macro data, we have now went from a $90 expected move to even bigger $94. That's plus or minus. The SPY right here was a $9.44 expected move. These are the upper level, lower levels, and the two sigma levels, just in case if we do get some sort of Black Monday or whatever type scenario this next week. Albeit, yes, there's some scare narratives out there, but we're only down 1.49%. Okay, that's well within what the monthly expected move was. And we can come all the way down here to about 41.11, 41.12, 4,100, and that would be where the prior price action kind of was, that big consolidation for multiple months. And that would be the lower monthly expected move. And that's totally to be expected if we were to continue to break down. But remember, we're working now. I mean, we haven't seen, when's the last time we saw, 3 red months in a row? All right, so 1 month down, 2 month, 3 month. I'd have to go back to look, but we're working out our potential third month down in the S&P 500, which is pretty rare. We only have to go up about 1.49%, which could be just one trading day based off of where the VIX currently lies as far as implied volatility. If we take a look at the SPY on the daily time frame, we got cracked the quarter to date anchored VWAP, and now it's starting to turn back around. We had mentioned that if we get back beneath it, or even below this low, watch out, be more careful. And then if you're longer term, make sure that this low holds. As it stands, we're still above an inclining year-to-date anchored VWAP. So perhaps after a strong move like this, we get some relief, but just understand that this is a high, this is a high, this is a high, this is a high, and what do they have in common? They're all lower highs. So really, to be a lot more bullish, you really want price to get back above this level. Till then, the trend on the daily time frame is down as it stands. If you take a look at something like on the daily time frame, like XVG, this is, or you can use SPXEW, which is a equal weight S&P 500. I mean, we broke down to another yearly low here in a value line, or the equal weight. And if you look back, we're not too far off the October low. We do have a positive divergence building on the RSI, just like we did back there in October. Coming into Monday, everyone's talking about Black Monday, but in 2023, right, 78% of the time on Mondays, the SPY finishes actually in the green. So it's more likely, based off of this year, being that the S&P 500 finished up 78% of the time, a green day, it's more likely, obviously, from a probability standpoint, that we will finish green come Monday morning. But you never know. Things may change. All right, if we take a look at the 15-minute time frame and update you on the expected moves, we have the weekly expected move up here at 430.63, down beneath us at 411.75, and then the daily expected moves are right here. If you want this chart deck, you can obviously download it. Now, on last video, we talked about it was looking good because we're getting above the 5-day moving average, right? We're above some anchored VWAPs like the week to date and so forth. But we had mentioned was if price gets back down beneath the 5-period moving average, press on the brakes. Be cautionary in that environment. Well, we started the day down there. Okay, so we started gapping down, which is already bearish. We try to recover it, stayed below the week to date, stayed below the 5-day, and you can see we tried to bounce up to it multiple times, got a lot of chop here by the green line, which is the quarter to day anchored VWAP, and then we broke down further by the weekly expected move, okay? So as it stands, yes, we have an RSI divergence that's building. You have a low, a higher low. RSI is putting in a higher high, a higher low. Okay, so if we do bounce, potentially look to see this prior area up here as a potential area of resistance, and that coincides kind of close to the upper daily expected move going into tomorrow. If we start breaking down further, if there's a lot more sell side, start looking over here. Now, if we get a big gap down come tomorrow, I would be watching this lower daily expected move. I would love for the day just to start down here because that would freak out a lot of people. Maybe we get a flush further, but the RSI would be so burnt to a crisp. This move, you would probably look for people to cover where you can see a quick snapback rally and you can make some money to the upside. But just understand that you're still very well in bearish territory as the 5-day moving average is starting to turn itself back over. We're beneath the quarter to date. We're below last week's week to date. And starting next week, we'll have a new one, a new week to date anchored VWAP there. If we take a look at back month versus front month volatility, we're back to where we were right before we saw this little bit of a bounce. You typically want to look for back month versus front month volatility to pull itself down to around this 1.0 reading. And that can mark potential bottoms where we've seen, bottoms kind of form at these low readings prior. You can see we saw this big move down. We saw a snap down, but then you saw a little bit of a move. Okay, obviously it sold off more over here. Saw it, boom, saw a little bit of a rip there. And then when this back month comes up to about 20%, which is 1.2 reading over here, boom, this sometimes marks topping points or potential tops for the S&P 500. So as it stands now, there's still potentially more room to drop here. Now, I want to close off by showing you a more bullish chart, or what could be very well bullish. As we're seeing breadth, so the NASDAQ record high percent index, as we're seeing breadth really deteriorate here, the market hasn't really broken down. So if we do get a stronger breakdown, what we want to watch for a potential bottom is breadth to start picking back up and getting back above that 35 reading. If that is the case, we've seen that mark bottoms multiple times, including the last one here at the October bottom. You can see that right here where price action was going sideways, over here in the great financial crisis, over here at the dot-com, over here in the early 90s there too as well. There is one flaw right here where it kind of upticked just slightly above it and then broke back down, giving us a little bit of a warning sign there right before that big sell-off. So I'd be watching for breadth to step back in, and that could potentially mark a bottom where we get another rally. But as it stands right now, the most important asset to be paying attention to is obviously bonds and yields, because from an intermarket standpoint, those things can really tear up the overall market. And I hope you understand why that might be after today's video. That's all I got for you. See you later.